$200. There it is again. I see this number everywhere I look now, in analyst reports, in technical charts, in the mathematical models, in the whispers of smart money investors. $200 for silver. It's like this number is haunting the precious metals market, appearing over and over again from completely independent sources, each one arriving at the same destination through different paths. And when you see multiple unrelated analyses converging on a single price target, when the number keeps appearing no matter which methodology you use, that's not coincidence. That's the market trying to tell you something crucial. Small investors must watch this carefully because what I'm about to explain could represent the most important investment opportunity of this decade. Let me tell you why this particular number won't leave me alone. I've been analyzing silver for over 3 decades. I've seen bull markets and bear markets. I've watched silver spike to $50 and crash back to single digits. I've observed every twist and turn this market has taken. And in all my years of analysis, I have never seen a price target appear with such consistency across so many different frameworks. $200 isn't just a number someone pulled out of thin air. It's a mathematical conclusion that emerges whether you're looking at inflation adjustment, monetary base expansion, gold to silver ratios, supply-demand fundamentals, or technical chart patterns. Every road leads to the same place, $200. Let's start with why this number keeps appearing in the inflation calculations. In January 1980, silver reached its all-time high of approximately $50 per ounce. Now, the mainstream financial media treats that as some sort of ancient peak that's no longer relevant. But here's what you need to understand. When you adjust that $50 high for the true rate of inflation since 1980, not the manipulated CPI that the government feeds you, but the real inflation that Americans experience at the grocery store, at the gas pump, in their housing costs, that $50 translates to somewhere between $190 and $250 in today's money. The number 200 sits right in the middle of that range. Silver hasn't even come close to matching its inflation-adjusted high. It's not just undervalued. It's drastically undervalued by any historical measure. But wait, the number appears again when we look at the monetary base. The Federal Reserve has expanded the money supply by extraordinary amounts since the 2008 financial crisis, and especially since the COVID pandemic, when they printed more money in a few months than they had in the previous century combined. When you calculate where silver should be trading based on the expansion of the monetary base, the same way you would calculate where any commodity should trade when you dramatically increase the number of dollars chasing a finite amount of goods, you arrive at a figure between $180 and $220 per ounce. There's that number again, 200. It keeps appearing like a mathematical ghost that refuses to be exorcised. Now let's talk about the gold to silver ratio, because this is where the number 200 becomes almost mathematically inevitable for anyone who understands market history. Currently, the gold to silver ratio sits above 80 to 1, meaning it takes more than 80 ounces of silver to buy 1 ounce of gold. This ratio is historically extreme. For most of recorded history, this ratio fluctuated between 12 to 1 and 20 to 1, based on the relative geological abundance of these metals in the Earth's crust. Even in modern times, the average ratio has been closer to 40 or 50 to 1. In precious metals bull markets, the ratio typically collapses as silver outperforms gold. In 1980, the ratio dropped to approximately 16 to 1. In 2011, it fell to around 30 to 1. If you see what I see, you understand what happens when we apply historical ratio compression to today's gold prices. Gold is currently trading above $3,000 per ounce. If the gold to silver ratio merely returns to its historical average of 40 to 1, which would still be conservative by bull market standards, silver would need to trade at $75. If the ratio compresses to 30 to 1, as it did in 2011, silver hits $100. And if the ratio approaches the extreme seen in 1980 at 16 to 1, which is entirely possible given that silver is actually rarer above ground than gold when you account for industrial consumption, silver would trade at nearly $200 per ounce. There's the number again. It appears no matter which direction I approach the analysis from. The supply-demand equation adds another dimension to why $200 keeps emerging as the logical price target. Most investors don't understand just how precarious the silver supply situation has become. For the past several years, we've been running persistent structural deficits, with demand exceeding mine supply by 150 to 250 million ounces annually. This deficit has been filled by drawing down above-ground inventories, but those inventories are now approaching critical levels. The COMEX registered silver inventories have been depleted by over 70 70% from their peaks. At current rates of depletion, we could see a genuine supply crisis within 12 to 24 months. What makes silver's supply situation particularly dangerous is that approximately 60% of supply comes as a byproduct of mining other metals, copper, zinc, lead, and gold. Silver production cannot be significantly increased by simply building more silver mines because there aren't enough primary silver deposits to make a difference. If a supply crisis hits, the mining industry cannot respond quickly. It takes 7 to 10 years to bring a new mine into production. The supply is essentially fixed in the short to medium term, while demand continues to grow exponentially. And let me tell you about the demand side, because this is where the story becomes truly explosive. The green energy revolution that governments worldwide are mandating requires massive amounts of silver. Solar panels are the fastest growing segment of silver demand, now consuming over 200 million ounces annually and growing at double-digit rates. Each solar panel requires approximately 20 grams of silver because of its unmatched electrical conductivity and durability. There is no substitute that performs as effectively. As the world pushes toward renewable energy targets, solar panel installations are projected to triple over the next decade. Do the math. That's an additional 400 million ounces of annual demand just from solar. Electric vehicles represent another massive source of silver demand growth. The average electric vehicle uses approximately 50 grams of silver, roughly twice the amount used in conventional vehicles. With EV adoption accelerating globally, this represents another 100+ million ounces of additional demand over the coming years. Then add in 5G infrastructure, which requires silver for every antenna and connection point. Add artificial intelligence data centers, which use silver extensively in electronics and cooling systems. Add medical applications, water purification, and the hundreds of other industrial uses for silver. The demand tsunami approaching the silver market is unlike anything we've seen before. Here's what the top 0.1% of stackers understand that average investors miss completely. Silver is unique among commodities. It occupies a dual role that no other element can claim. Silver is simultaneously a precious monetary metal with a 5,000-year history as money and a critical industrial commodity essential to modern technology. Gold is primarily monetary. Industrial uses account for less than 10% of demand. Other industrial commodities like copper or lithium have no monetary role whatsoever. Silver sits alone at the intersection of these two worlds, which is why its price behavior is so explosive once it starts moving. During monetary crises, silver benefits from safe haven flows just like gold. But during industrial booms, silver benefits from technological demand just like copper. And because the silver market is so small, the entire annual mine supply is worth roughly $25 billion, less than a single day's trading volume on the stock market. It takes very little money to move prices dramatically. When monetary and industrial demand surge simultaneously, as they appear poised to do, silver doesn't just rise, it explodes. That's why analysts looking at silver from completely different angles, some focusing on monetary factors, others on industrial fundamentals, keep arriving at the same number. $200 is where these forces converge. The behavioral aspect of silver investing is fascinating and explains why most investors will miss this opportunity until it's too late. $200 seems impossible to someone anchored to current prices around $30 to $35. A 6 to 7x increase feels like fantasy. But remember, silver went from roughly $4 in 2001 to nearly $50 in 2011. That's a 12 times increase in a decade. A move to $200 from current levels would be less than the move we already witnessed in the 2000s bull market. History says this is not only possible, but has already happened within recent memory. The psychological challenge is that humans are notoriously bad at anticipating exponential moves. We think linearly. We imagine silver going from 30 to 40 to 50 over many years. We don't imagine silver going from 30 to 70 to 150 to 200 in a compressed time frame. But that's exactly how commodity bull markets unfold. They're not steady and linear, they're explosive and parabolic. The 1970s bull market saw silver rise from under $2 to $50 on a 25 times increase. The 2000s bull market saw a 12 times increase. Why would anyone assume the next bull market would be more modest, especially when the fundamentals are stronger than ever before? Let me address the skeptics who say $200 silver would require some kind of catastrophe that nobody should want. Here's my response. The catastrophe is already baked in. The debt levels are already unsustainable. The deficit spending is already out of control. The monetary debasement has already occurred. The supply crisis is already developing. We're not talking about causing these problems. We're talking about recognizing them and positioning accordingly. $200 silver isn't a wish or a hope. It's a consequence of policies that have already been implemented. The math is already done. We're just waiting for the market to fully reflect reality. What truly concerns me is how few people understand the opportunity sitting right in front of them. I talk to investors every day who have hundreds of thousands of dollars in stocks trading at record valuations, in bonds paying negative real yields, in real estate at bubble prices, yet they own zero silver. They have no exposure whatsoever to an asset that could multiply 6 or 7 times based on simple mathematical realities. They're betting everything on the financial status quo, continuing indefinitely while ignoring the blinking warning lights everywhere. This is not prudent diversification. Why, this is willful blindness. The smart money understands what's happening. Central banks around the world have been accumulating gold at the fastest pace in over 50 years. They're dumping treasury bonds and buying hard assets. They see what's coming. Billionaires are quietly building positions in precious metals through family offices and private storage facilities. Major banks that spent years suppressing precious metals prices are now issuing bullish forecasts. The positioning is shifting right now, while the price is still reasonable. By the time the mainstream media tells you to buy silver, the price will be multiples higher than it is today. For small investors watching this, you have an opportunity that is increasingly rare in modern markets, the chance to position ahead of institutional money rather than behind it. Silver is still accessible. You can still buy physical silver at your local coin shop. You can still purchase silver mining stocks at reasonable valuations. You can still build a meaningful position before the supply crisis becomes front page news. But this window is closing. Every week, more inventory leaves the COMEX. Every week, more silver disappears into solar panels and electronics. Every week, the above-ground stockpiles shrink. At some point, the metal simply won't be available at current prices. I want to be specific about how I believe investors should approach this opportunity. This is not about taking a small speculative position and hoping for the best. This is about making a strategic allocation that reflects the mathematical realities of the situation. For most investors, I would suggest a meaningful allocation to physical silver, coins, bars, rounds, stored securely in your possession or in allocated storage. This is your insurance policy, your protection against worst-case scenarios, your guarantee that you'll have something of value no matter what happens to the financial system. Beyond physical metal, silver mining stocks offer extraordinary leverage to rising silver prices. Consider a mining company with all-in sustaining costs of $15 per ounce. At $30 silver, they make $15 profit per ounce. At $100 silver, they make $85 profit per ounce. At $200 silver, they make $185 profit per ounce. That's not a doubling of profit or a tripling. That's a 12 times increase in profit for every ounce produced. This operating leverage is why quality mining stocks can rise 1,000, 2,000, even 5,000% during major precious metals bull markets. The number 200 appears yet again when I analyze the potential returns from silver mining stocks. If silver reaches $200 and mining company earnings expand accordingly, many quality silver miners trading at depressed valuations today could easily see share prices of 10, 20, even 50 times current levels. A $50,000 investment in carefully selected silver mining stocks could potentially grow to $500,000 or even $1 million during a major bull market. These are not fantasy returns. They're consistent with what happened to gold and silver mining stocks in the 1970s and 2000s bull markets. But timing is everything. The best returns go to those who position early before the crowd recognizes what's happening. Right now, silver remains unloved and under-owned by institutional investors. Precious metals funds are a tiny fraction of total assets under management. Silver mining stocks trade at valuations that imply the current depressed prices will continue forever. This creates the setup for explosive gains when sentiment shifts. Once the crowd recognizes the supply crisis, once inflation becomes impossible to ignore, once the dollar's weakness becomes undeniable, it will be too late to buy at current prices. The train will have left the station. $200 keeps appearing because it represents the mathematical center of where silver should trade based on multiple independent analytical frameworks. It's not the ceiling. It could easily exceed 200 if the gold to silver ratio collapses to historical norms during a mania phase. It's not a guarantee. Markets can remain irrational for extended periods, but it is the number that keeps emerging no matter how I approach the analysis. And when a number appears that consistently across inflation calculations, monetary analysis, ratio studies, and supply-demand models, you need to pay attention. The market is telling you something important. I've been in this business long enough to know that the biggest investment opportunities are rarely comfortable. Buying silver when everyone is focused on artificial intelligence stocks and crypto speculation feels contrarian and even outdated to many investors. That's precisely why the opportunity exists. If everyone saw it clearly, the price would already reflect it. Great investments require seeing what others miss and having the conviction to act before the crowd confirms your thesis. $200 silver will seem obvious in hindsight. The only question is whether you'll be positioned to benefit or whether you'll be among those wishing they had listened. The number won't stop appearing because reality won't stop existing. The money printing has happened. The supply deficits are real. The industrial demand is growing. The monetary history is written. The mathematics lead inexorably to higher prices. $200 for silver is not a matter of if, but when. It could take 2 years or 5 years or 10 years, but the destination is clear to anyone willing to do the analysis objectively. And for those who position now at the beginning of this move rather than at the end, the rewards could be generational. The window is open but closing. The price is still accessible but rising. The opportunity is still available but shrinking. Don't wait for CNBC to tell you to buy silver at $150. Don't wait for your neighbor to brag about his silver gains while you miss the move. Don't wait for the supply crisis to make headlines when physical metal becomes impossible to find. Act now while the number 200 still seems impossible to most people. That's how fortunes are made, by recognizing mathematical certainties before they become obvious to everyone else. $200 silver is appearing everywhere for a reason. The question is whether you'll listen to what the market is telling you or whether you'll dismiss the signs until it's too late.